our COBT viewers and listeners, it's Maynard, Arjun, and Mike here with something we are ecstatic about. I don't use that word very often, but I've got to use it today. We've got Karl Johnny Hersvik with us. His friends call him Kale, so we'll call him Kale, we hope. But he's the CEO of Aker BP. He's been CEO since 2014. Aker BP is an exploration focused company in the Norwegian continental shelf. What we would tell you and why we're so excited about this is when it comes to technology, the application of all the latest and thinking about the future of oil and gas and doing it in the best way possible, he's really a leader. The company's really a leader. We know that from our direct interactions and also from our friends. So we're thrilled he's in Houston this week, seeing some partners. And so we're just delighted, Kale, that you would spend some time with us.
Thank you so much for the invitation.
All right, we're so excited. Mike, another boring day in the markets, huh?
Yeah, it's always.
Is anybody talking about that Hormuz thing? Not to make light of it.
No, everyone's talking about SpaceX, right?
Okay.
I mean, there's nothing else
Finally
that really matters right now but the SpaceX IPO, right? Look, I mean, I think, we've been talking about, the Gulf, the basically Hormuz being shut down for, this is going on the 15th week, right? I think people are getting a little immune to it. Oil and gas, they're moving based on what's going on. Hey, oil's been between 85 and 105 when, we have basically bombs flying, 85 when, it looks like we're going to come to a resolution. Right now, we're sitting at $89 a barrel. We're down a couple bucks this week because this ceasefire seems to be holding. And so I'd say from an oil market standpoint, what's interesting to me is talk a couple weeks ago was how high is oil going to go here because summer's coming. The physical market's going to start taking over. And the discussion this week in the last 2 weeks is, okay, well, what happens when the war is over? How are these wells going to respond when they bring it back on? What are shut-in wells are going to look like? And there's a big divergence of what people think. Some people think that it's going to take months and months. Some people think 800,000 barrels is not coming back to the market. We don't know. In my opinion, every time we talk about these shut-in wells coming back in, everyone underestimates what these wells are going to do, and they come on as good or better. And so I take the over on that, but that is the big discussion at this point in time. So we'll see how things play out. I'd say from a broader market standpoint, the market has been hitting all-time highs. It's seen, every week for the last, since the beginning of the year. Last week was the first week that we did not have the market going up. It was down about 1.5%. So that kind of broke a 9-week string. And the stocks that were getting hit were like chip stocks, right? Some of these AI stocks. And so it looked like, there for 1 week, there was a leadership change in the market where the semiconductors, the AI stocks took a backseat to more of these defensive sectors. It's not the case this week, but we'll see. We're early in the week. We'll see how things go on. Like we talked about earlier, the SpaceX IPO is coming here on Thursday. It's being priced. It's going to be trading Friday. That's going to be $1.75 trillion to $2 trillion of market cap. That's a lot of, room that needs to be made in portfolios. And so I would expect, some of these tech stocks and some other areas are probably not going to perform as well because you're going to have those dollars flowing to that IPO. So that's interesting. The last thing I'd say is, we've got a heavyweight Norwegian, oil and gas company today, but I have to basically say that, Equinor is going to have their capital markets day. And the thing I thought it was next week, and the thing I thought was interesting, this is going to be their 25th year anniversary of being a public company, being listed on the Oslo and the New York Stock Exchange is, 25 years. That's a notable accomplishment. This company right here is right up there, in my opinion, from a technology standpoint. So we'll leave it there.
All right, it's exciting. Arjun, what would you throw in before we jump in?
Well, I'm going to build on a couple of Mike's comments. First, in memory of Equinor, I have to give a shout out to my friend, the former CEO of Statoil, Harold Nordvik, who I think might listen to this. He's a former director of a company whose board I'm on, and a real pleasure to have interacted with him over the years. But I really want to build upon the oil macro comments that Mike mentioned, maybe give a little bit of a longer term perspective on how we're thinking about Hormuz and the path forward. And I think I'll start off by saying, no one knows. No one absolutely knows how this is going to play out, what the volumes are going to be, and so forth. I'm going to agree with Mike on the shut-in volumes in the kingdom and UAE. I'll take the over on that coming back. And I think we might debate Iraq and the timing of those volumes coming back. But there's about 50 million barrels a day of crude that we're going to focus on here. 5 has been redirected to Saudi east to west in the UAE line that avoids the strait. which is about 10, and that we're going to call sustainable, ongoing ability to avoid the strait. There's about 10 million barrels a day we're talking about. And you've got SPR draws in the US, higher crude exports from the US without actually higher production, two elements that are about 2.5 million barrels a day, maybe another half from other SPRs. There's basically drawing inventory. You've got China that is not importing somewhere around 4.5 to 5 million barrels a day. So of this 10 million barrel a day, I'm going to call debatable amount of Hormuz oil, at least 7 to 8 of it, we're going to say is inventory draw that has a shelf life to it. The other two, I think we can debate how much oil is kind of secretly getting out on some tankers and these kind of things, or a little bit of demand erosion in the Asian countries, work from home, jet flights and others that might have been canceled ahead of time. But how do you resolve this? And this is where the timing issue is really relevant. The longer this continues to stay closed, the longer those tweets do not come true. Yes, you'll have higher prices in the short term, but it's a really bad outcome. That is your global recession outcome. And there is nothing good about trying to force 8, 9, 10 million barrels a day of demand out of the system. We are not there yet because the combination of the US, SPRs, and China has done the heavy lifting in essentially de facto drawing inventory. And we're all just trying to debate the over-under. Is it end of July, end of August, somewhere in that time frame where that starts running out? It's a downside scenario, though. There is nothing, we've said it since the start, there's nothing good about war. It's not good for citizens, it's not good for the military, it's not good for governments, businesses, and it is not good for oil and gas companies. There is nothing good about forcing demand down to available supply. We are rooting for peace. We are rooting for the opening. And so as we get confidence that shut-in wells are going to come back quickly, because I agree with Mike, I think UAE and the kingdom is going to come back quickly, and probably we might call it flush production after you shut in the wells. And our guests will probably have a better view than we will on that. We're rooting for that outcome because that then ensures economic growth and oil demand can continue. The last point I want to mention is, and we had it in our meeting yesterday, which is how does this all settle out? And our view has been geopolitical super vol. And I feel like people think that's a marketing term. We mean it as a way of life. There is not an oil price we are looking for. And it's really hard to get people's arms around that. They want you to have a view, well, it used to be 60, now it's going to be plus 10 for geopolitical risk premium. It's going to be 70, or it's going to be 100 or 150 if you're a Super Bowl, or it's going to be 50 if you're a Super Bear. None of that is how we see this market. It is not a smooth cycle. And so I'm going to speak to the corporate executives out there. It's about having a planning function where are you prepared for that recession scenario? I'm going to call it a normal trough, $55 oil, 50 to 60. Can you earn a cost of capital return in that environment? What if we have a deep trough? What if we have to knock 10 million barrels a day out of demand? And then you ultimately overcorrect on the downside. Can you never lose money in whatever that deep trough is? And then how do you think about the periods where we might have $100, $150 oil? And how do you take that cash flow and bolster the balance sheet and take advantages down the line? And so we might make up an average oil price of 75 or something like that is where we might average over this period. But it's really that mindset of embracing super volatility and not trying to pin yourself down to some point estimate of 70 or 75. And it's for corporate executives. I think it's really hard to be a publicly traded company because the market wants this smoothness. It's why Mike is correct. Everyone's so excited about SpaceX. We can dream of a huge TAM, and there may be some choppiness along the way, but it's Elon Musk, it's space, it's an awesome area. Here we're dealing with 50, 150, whipping back and forth. Some random guy with a drone shuts down the strait again. This notion of open and close is not a thing anymore. And so for private equity companies, I see the appeal. I think the real challenge is how do you be a publicly traded company and thrive in this environment? The final point is when you have this kind of volatile environment, you're not going to get the super cycle capex. And I think that means that ultimately we'll see where demand and supply settle out, but you end up with kind of a better return on capital profile for the sector, albeit volatile. And then how do you value that as an investor? And I'm going to already gone on way too long. But I think it's a bigger question for investors. But I think for companies, what an awesome opportunity to be in a business where all of your peers are going to be scared to spend money. And how do you take advantage of that volatility to grow your business?
Well, look, guys, that was awesome. Kali, I think it's a real testament to you because our lead-ins are usually not that spirited. So, I mean, great job. You've already got us going.
I haven't said
It's
anything.
easier in person than being online. So
I mentioned in the lead-in what we're so struck by, Kali. I think, first met you, it's probably not quite 10 years ago when John Gibson was helping us think about energy tech at BPH.
Okay.
But I really meant what I said in the lead-in, which is when you talk to people in the oil and gas and technology community broadly, and you say, who's doing it, who's out on the cutting edge, who's doing some really neat things, your name is always near the top of the list. So, congrats.
Thank you.
Well, so many places to start. Maybe we listened to your earnings call. Things are going well. You're 400,000 barrel of oil producer.
Yeah.
Talk to us about some of the innovative things happening at the company, because this is such a dynamic time, and we'd love to hear about it.
Absolutely. So maybe the place to start is that this whole journey actually started back in 2016. We're actually celebrating 10 years now since the merger with BP in Norway, which kind of transformed the company and was a really a landmark transaction. And the formulation of Aker BP is in reality too big and about 19-20 minor transactions. So the first one was obviously back in 2014 with the $2.7 billion acquisition of Marathon's assets in Norway. And then in 16, almost to the day, 2 years later, we did the merger with BP. So that basically changed. But then you have to ask yourself some very fundamental questions, right? So you're kind of moving along from this specialist, minor, independent model. And you have to ask yourself, what works and what do not work in our industry? Where do I feel that we are kind of close to that productivity limit? And where do I feel that we're not really that close? And out of that exercise, there was 3 basic observations, which I think has still remained the strategy of Aker BP, even though the IR guys have a tendency of changing the slides every second year or so to sound more dynamic. It's basically been the way we've thought about it. So our comparison of the offshore industry to call it an onshore retail industry was that we were really not that productive. I mean, the industrial excellence type of thinking was not really relevant, right? So you were probably, as a management team and as a organization and as a board, you were thinking about more risk management than margin management. The question was, when we discovered one of the major fields, it wasn't are we going to earn money? It was how much money are we going to earn? So you kind of had the organization fall into this idea that this is really not about the margin. It is really about the risk management. But those two are very, very different topics, right? So if you're operating an asset, you're trying to make that as smooth as you possibly can. So this whole idea around getting really, really efficient at something, and then getting a whole organization to wake up every morning and say, today will be a little bit better than yesterday. So we've implemented lean, and that was a disaster, and now we're doing lots of different stuff. And I don't really care from a leadership perspective what they're doing, as long as they do plan, do, study, act, as long as that is a systematic way of improving. And that's actually worked, but it took 10 years. But now we're at 97% production efficiency, meaning we're utilizing 97% of the install base. We're probably leading in terms of energy efficiency, with roughly 2.4, 2.5 kilograms of CO2 per barrel of oil equivalent. We're operating offshore at the cost of roughly $7 a barrel, which is really kind of significantly ahead. But also, if you look at the parameters behind, which I'm caring about, this how much overdue maintenance, how much planning efficiency do we have? Gone from kind of middle of the pack planning efficiency, which was really kind of towards the top end of offshore industry, around 80% planning efficiency, to now we're not happy if we're not at 96, 97, 99%. That's a totally different world. So that kind of almost extreme focus on operational efficiency and productivity and improvement. That was number one. Number two, we never really got our head around how the oil companies and the vendors interacting. To me, it sounded like a fantastic source of inefficiencies. We weren't really learning. We weren't really standardizing. We were ending up in cycles that were far too long because we were tendering all the time. And I never really understood that, because if you look at this from a capital allocation perspective, an oil company spends about 90% of its capex outside the company. So why aren't you optimizing that cash flow with your vendors? That led to quite a series of investigations, and we came across the alliance model. I spent 3 weeks standing on the floor of a factory in Japan looking at Toyotas being assembled. Came to the conclusion that we could never replicate this. But the same model I found in Volvo Heavy Trucks in Gothenburg, which had this idea of an alliance construction where risk being shared, data flowed, etc., etc. So we basically stole that and built the alliance model on that. The alliance model itself is 3 components. It's one organization, so everybody is focused on one task, independent of what it says on your card. You are part of one organization. We have one way of solving the operational issues, right? Because these are not changing. So if we're drilling a well, we're drilling a well with Halibut. If we're doing a jackup, we're doing it with Noble. If we're doing a field development, we're doing it with Aker Solutions. If we're doing a subsea field development, we're doing it with one subsea for SPS equipment and Subsea 7 for SURF. And we've been doing that for 10 years. So now you get a learning cycle, you avoid in tendering, and you can actually start to benchmark. So that benchmarking is now kind of leaning on my first point. You get an organization that are driven by performance management, real data, and excellence. And then we're super happy to share the upside. So a lot of this kind of transactional mechanism is built on what you could call bonuses, right? So think of this like, okay, we have a cost-based pricing structure, absolutely. But if we can save a buck as an oil company, we're more than happy to give the vendor side of the alliance 70 cents of that buck. Because you're compressing time, which is incredibly important for us because of WACC and the market standpoint. The second one,
Kyle, I don't mean to interrupt you, but I think that's very rare to have that kind of bonus structure in the alliance model as an upstream company. I feel like the service industry has wanted this, and you seem to be one of the first that I can remember that's really implemented it.
Yeah, I don't think many have. And it's not because we're not sharing, because we are basically giving away everything, because it seems to be very, very difficult to implement. Mostly, I believe, because of cultural issues in these organizations. They are used to a hub and spoke model. They're used to kind of being the king of the anthill. But you have to start thinking like one team. You have to think about the task being solved, and that you're really agnostic to whether it's being solved by an Aker BP employee, an Aker Solutions employee, or a Halliburton. Don't really care. Best man and best woman for the job.
Okay, unfair question to all our friends in procurement. But once you create a procurement department, does that almost create the structure that you're trying to avoid, because that department is all about processes and tenders and contracts and bidding and things like that?
I think it's true for any process that as soon as you solidify it in governance documents and organizations and structures and traditions, it's getting hard to change. So I think to a certain degree that is true.
Maybe you just have to get the procurement department working on margin, not necessarily on cost.
I think you need. I think that the biggest challenge I found in this alliance model is not really the structure. It is the trust and the commitment from the top of these companies. Because in reality, the first 5 or 6 years was a series of experiments. And the way we think about the experiments in Aker BP, which is probably different from a lot of other companies, we try to kind of experiment on a level where it's not a disaster if we fail, but we do follow a kind of a almost science perspective. We design experiments to fail. We're actually interested in where that failure point is, because that's where the key learning is. So then you fix that and you go it again, and you fix it and you go it again. Most organizations are designing experiments to succeed, but then you don't really know where the key choke points in that kind of value chain was. So you're not really having a full set of information. But you can't do that if you're doing experiments with stuff that would kill the company, right? So this whole idea that rather than having a one big kind of cannonball firing, you do lots of smaller shots, and then once you got it right, that's when you really hit it.
So those, and I don't want to lose your track because you've got the third thing coming about how you.
I think it's the second thing coming.
Well, no, this was the second one, was the alliance, and now the third thing is. But the teams that you work with at those companies, Halliburton, Noble, all of those companies you listed, does it, as a result of the structure, does it tend to be the exact same people
To
for
a
years?
certain degree, yes.
Mm.
And for good reasons. So first of all, there is a certain set of people that like to work as a one team type of structure.
Mm.
There are a certain set of people who really enjoy that kind of transactional way of working, and they're not necessarily going to be successful in these alliances.
Mm-hmm.
There is a certain set of humbleness. I mean, you need to listen more than you talk, which is sometimes complicated. And then, I know this is probably one of the more profound realizations, is that it's surprising how much the customer is a part of the vendor's quality control system. So I'm selling you something, but before we actually go out and do it, I send you the program and how I'm going to do it. And you have a team of individuals that look at it and provide comments and goes back and forth. And then when we're in agreement, we go act. If you take away that and say, fine, you're responsible for doing this, it changes how you think about your own quality control. Right? So the operation model inside Alliance is slightly different from the operation model that these companies needs to run towards the other customers. So that means that there is a certain set of individuals that have a tendency of becoming prevalent in these alliance structures. And then we are encouraging our alliance partners to take these individuals and actually try to replicate the same structure, usually with different names, with other customers, because we were actually interested in this model migrating outside the Aker BP relationship, because we believe that the more momentum this kind of model will get, the better the productivity gain will be. Which kind of leads me out to the third point in the strategy, and this is probably where you started, this technology implementation development type of idea. And that also started back in 2016, basically out of the same realization. So I think of a business process and a value stream as a system with two bloodlines in a way, right? The first one is capital, the second one is data. And while capital has been fairly well studied, I came to a realization that data were not really flowing the way it should be flowing. So the data was basically entrenched in monolithic structures where SORs and databases were the same kind of component that the human machine interface or the human interface, the GUI, that would consume the data. And it was very, very difficult to liberate data flowing from different parts of the organization into one single source of truth. So we started this idea that data and the transforms that are working on the data should be separate and not a part of one idea. We worked.
Do you mind saying that again? Because that was.
Yeah, so imagine I like to use real-time data coming out of the control systems as an example. That has a tendency of ending up in some sort of monolithic structure. And then if you're going to do something like an inspection of a faulty relay or pump or whatever, you're mirroring that data through some sort of system where a lot of the information has been taken out, or you actually have somebody come in and look at your SCADA system in totality. It's not really flowing. It's not expectable. In 2016, we haven't really thought about LLMs, but now, how do you actually create a system where you can actually bolt on agents if the data is not flowing and it's not to a certain data model and a certain spec and a certain protocol? So this idea of separating data from the transforms that are working on the data was a very fundamental idea back in 2016. And we worked with a company called Cognite, and with their pilot customers and investors, and Aker also invested in Cognite, obviously, and created what is basically a knowledge graph type of structure. The interesting thing right now is that is probably now in 2026 the industry standard for how you organize data if you want agents to act on them seamlessly. So now we have ended up in a structure 10 years later where we have three basic data platforms. We're using Fabric for anything that is basically office oriented. We use CDM or CDF, which is the Cognite products, the graph structures for anything that's operation oriented. And we use an OSDU structure for anything that's subsurface oriented, right? So now we can actually decompose the whole system and run agents across. And that has actually led us to define very critically that we'll try to become the first AI native oil and gas company, right? And the simple thing is, imagine what, imagine what these language models have done to coding. So start imagining vibe engineering rather than vibe coding. If you're going to do vibe engineering where the engineer's competence are codified into agents, and these agents act as systems to develop that structure, you can compress the time it takes to conduct an engineering task quite ridiculous. And we run experiments, real live experiments, something called root cause analysis, which every oil and gas company, every industrial company do. Typically very involved exercise, very stringent, takes 6, 7, 8 weeks to do. The average improvement from the set of RCA agents that are running now is 97 to 99% improvement in time. And accuracy is increasing, right? So you are ending up in a situation where you thought, okay, we need to do something different. So I've set a target with Aker BP, and people are laughing. I've set a target that Aker BP will try to improve productivity, which is all input factors, inclusive of time that it takes to drive a barrel from a discovery well to the market, with improved productivity with 300%. Not 30%, but 300%. Fundamentally change the way we're actually running these companies.
So when I hadn't heard vibe engineering before. That's a new one. When you think about that improvement that you're noticing and that you're targeting, like as you break it down, like what are the sources of that improvement?
So I think the key source of that improvement is compression in engineering standards. So and it's a combination, right? So because of these alliances, we now have a very stable, call it ecosystem of competencies, vendors, products, standards that allows us to create data models and semantic models for basically everything we do. We've had the same vendors now for close to 10 years, right? On top of that, you can start codifying engineering competence and engineering knowledge. And because we've done the same thing so many times, I wouldn't say it's simple, but it's clear to us how a certain task is being executed, whether that is inside the oil and gas company or inside the alliance, right? Because we've done it repeatedly. The codification of competence is easier in these kind of structures than if you do a one-off. Second, we've spent an enormous amount of time on data modeling, which I think is probably a very boring topic. But the way to think about that is, if you're going to get agents to work on industrial data, you need to create that language. Data modeling, semantic data models are actually the language that these models need to learn to be able to respond with industrially relatable data sets. And then the third element is essentially how we think about standardization. And that's it, linked interestingly to another one, because if you're doing engineering and agents engineering, you need some guardrails, right? You need some standards. If you have an indefinite set of opportunities, you are going to run a relay loop or something. But the problem is that agents work in that kind of loop outside the codification don't really seem to, at least at this point in time, concentrate, and we're not getting that kind of response that we're getting. So we need governance, we need structure, we need guardrails. Standards are actually that guardrail. So by defining those standards, you're actually entering into a situation where the standards itself is helping improvement because it's allowing the agents guardrails to conduct business.
So would you mind giving us one of those standards? Just like an example.
Yeah, we've implemented something we call a global operational data model. So what that is, it tells you how a tag on a platform is linked to documents, PNIDs, etc., etc. So now I can say, I want to see every pump on every installation with this set of characteristics. And I don't need to go look at all the documentation because that pump, that language of a pump now has a very clear definition. So the agent can find any pump on any installation because it is the same definition, right? It's like when I use this language equivalent, right? So if you want to say we're doing soccer, that's a specific meaning, different to football. But if the model doesn't know that he's looking for soccer or football and has the same assumption, you're getting lots of erroneous false positive errors. But you have a very stringent definition of the word, in this case, soccer, then you're getting only those matches, right? So I think we forget that these technologies are fundamentally based on token prediction. Token prediction is a semantic process. Data models are the semantics of the industry.
So of those three things, the standardization and then the data quality, and then the way I heard the first one was a little bit like agents allow you to find the best practice in the company and make sure that it's being spread across the whole company. That's not what you said, but I was kind of is that one way to internalize what you said?
Think about this like almost like a ladder structure. So the first way of deploying agent is that you accelerate human work processes. Human work processes are sequential in nature. We have a tendency of
we go to bed.
Yeah, some of us do. But think of this more like a sequence of, I have an idea, I investigate some data, I verify the idea, and then based on that idea, I develop it a bit further. I test it against but you're doing everything, all of this in sequence, right? So lots of these agents, they will do what you talk about. They will accelerate that process, but it's still a sequential process. It's still essentially a human-driven and designed process.
Yeah.
Then you have what we call augmentation, which is the next step, where you're essentially doing the same, but you're expanding that probability set. So it's not just looking at your data. It could be looking at everybody else's data. It could be interacting with an OEM agent that has access to not just your equipment, but all equipment installed by that company globally, et cetera, Again, it's easy to do, actually, quite easy to do now, but it doesn't really need the reconstruction of the business model. And then what we're trying to do now is more towards the automation, where agents are actually doing work and humans are inspecting the result. So now you go from sequential to concurrent and parallel. Humans go from being involved in the work to training the model and overseeing the results. And organizations fundamentally change because they're not a part of the execution, they're part of the training.
So this alliance model, if you didn't have that, you couldn't capture all these around data sharing and agent sharing and all this stuff. If you didn't have this alliance model, how would you possibly make all that work?
I think the alliance model is almost like a turbocharger. So we get rid of a lot of the stoppages that we would have in a one-off contractual relationship, because then you would have a lot of legalities and a lot of stuff that you would have to solve differently. Because we have this alliance model, it allows us to experiment much more freely. And as Jeff Miller said in Halliburton yesterday, we don't know where we'll end up, but we're super happy to experiment with you guys because we know you will treat us fairly. I mean, that is probably kind of a little bit of a secret sauce into this.
It seems like a lot of the discussion we've had so far is like, a lot of the processes after you find a barrel of oil. And I want to throw a couple things out there before I ask you a question. First of all, you're a little over 400,000 barrels a day of production, and you're going to go down to 370 to 400 is your guidance. And then you've had some discoveries, and by 2028, you're going to be at 525 and then holding 500,000 barrels a day out into the 2030s. So the question I have is just an exploration question. I mean, for a 25 to $30 billion enterprise value company, you seem to be way out on exploration. That is a core competency that's ingrained in your culture. Maybe you talk about some of the processes we talked about, what you're bringing to the exploration side, because definitely you're unique in that standpoint. I mean, I don't know many companies that would let their production fall to have their production 3, 4, 5 years out grow from there. That's just not how companies work. Just maybe talk about the culture, just the exploration side of the business for us, and how you're bringing these agents to help with that.
Yeah, I think the first part of your statement rather than the question, what we're in the middle of now is executing a $20 billion greenfield program, and that meant that we have moved a lot of resources away from, you could call it, the normal execution line into these projects. That means that we've spent time building topsides and platforms and God knows what not. But we're doing that because the return on capital deployed is better by spending the resources that way than by keeping production flat. And then this idea that you should keep production flat because that's what everybody expects, that's fine. But we're not here because everybody else wants to do something. We're here to maximize return on capital employed. And then the profile turns out to be this. And this then essentially it's basically driven by a decision made by the Norwegian government back in 2022, where they put a tax incentive in place for greenfield developments, meaning that we have 87.16% government take of all the capex and then 78% of all the income, right? So you're getting almost a 2-to-1, which is kind of really fueling that kind of capital efficiency for the after tax, from an after tax perspective. Then thinking about exploration, I think exploration is probably the area where agentic workflows, data assimilation, and structure is having the highest potential, but it's also one of the most complicated areas to deploy it. So a few stats. In Norway, about 750 documents are handed in when licenses are being returned to the government each year. Every one of these documents are around 1,500 to 1,000 pages long. So even if you wanted to, you couldn't sit down and read all this documentation. That's not a problem for an agent. You can dissect this information in 10 minutes or so. The second, it needs a lot of guardrails. So there's a lot of, call it, conventional tooling, like mathematical analysis of well logs or processing of seismic, right? So what we're doing at this point in time, we're creating systems that are combining unstructured information, structured information, because geologists know what to look for. So this kind of codification of what an explorationists are looking for. And then tooling in terms of analysis, systematics, seismic interpretation, petrophysical interpretation, reservoir simulation, but run by the agents. So now you can actually create experiments where you say, I'm interested in this platform and this reservoir. I have an idea that there might be an oil accumulation in this horizon and that the source rock might be that. Give me all the data that supports that assumption and all the data that negates that assumption, and run experiments to provide probabilities. Okay, and then go away. And 4 hours later, you come back and there is an experiment that has been run where they've drilled a digital well at that location and made a prediction. And you can, by segmenting data, you can also test these agents against real data. So you can actually test whether they are predictive or not predictive. So this is probably the area where we spend the most of our resources. And the idea is that we need to get a lot more. We need to be significantly higher in kind of probability, because the accumulations per accumulation is probably smaller in the future than just the creaming curve. But also because we want to spend drilling not because we have an idea, but because we're testing a concept where we have a predefined idea of what we're testing and why we're testing it, right? So you want to build a knowledge model where you're kind of adding to that model every well you're drilling, not discovering something and then going back to rethink everything. Then this is an area where everybody has their own bias. And I never bought into this idea of the lonely explorationist sitting in his office and coming up with fantastic ideas, right? The world, I mean, there are obvious examples, but from a statistical point of view, the world doesn't work like that. But if you can decide, if you can use tooling to decide where do we have certain biases and what is a bias-free analysis of a data set, then you can actually get to fairly interesting results. And this is not new. In 2024, there was a paper written, you can find it if you search, which basically checked for diagnostics on humans. Doctors alone, right, approximately 74% of the time. Doctors with AI, that added only a percentage point. AI alone was 10% better. So AI alone was significantly better than humans with artificial intelligence. Why do you think that is? Because you're using the tooling to support your own biases, right? So what we really want to do is to have unsupported decision bases where the human bias is kind of providing the coloring because it's sometimes useful, but where we are aware of what is the human bias and what is the actual accumulation of facts. And the third part of that is you can actually, using the amount of data that is available in any continental shelf, you can create almost like, call it a digital model of the whole shelf. And then you can use that as a digital playground and allow agents to construct and reconstruct, because the problem here is that there's not a unique answer to how all of this data fit together to get some sort of geological concept. But as you're adding information and drilling wells and adding new information, you're narrowing in that space, right? And there's a big risk, and that's happened quite often also in Aker BP, that you end up doing this Newtonian estimation and you end up at a local minima and you think you're at a global minima and then discover that you're not. So by using that digital model, and using the data modeling, using the agentics, using the fact that we have disconnected data from the tooling, which also allows agents to use tooling that we wouldn't allow them to use otherwise, that gives you an idea of where to look and how to look.
That was a great discussion so far, and I love how you described the productivity improvements, the alliances, but especially being a native AI company. I wanted to ask you, as a Norway-focused company, the concept of getting more out of existing assets versus going to other parts of the world. And so you may not know this, I was born in April of 1969. I'm going to ask you if you know what else was born in April of 1969.
The moon landing?
Ekofisk. One of the greatest discoveries in the world, but certainly in Norway. And I've seen over my career how that has been developed and redeveloped, and whatever that original recovery rate was, it's been far exceeded over the course of what is now a 57-year life of that field. And my question is really about, there's I think, a physical limit to geology and physics of oil reservoirs.
Sure.
How can we think about what you're doing with the productivity improvements, the AI native, all the things we've discussed today, and the significant cost savings and improvements you can get? How do we think about that applying to, I'm going to call it, the limits of geology? Within your asset base, where are we in that? because I think one of the questions for companies like Aker BP is, do you ultimately have to expand some other country? Your fellow Norwegian company, Statoil, now Equinor, have decided at some point they needed to go to other parts of the world. Now it's a larger company. But how do you think about that sort of, I'm an equity analyst, inherent geologic and physical limits versus what you're doing, which to me sounds remarkable on all this AI native and alliances and so forth.
So let's start with the basics. So I believe that if you're going to get really, really good at something, I mean, truly good at something, you need to concentrate. You can't do everything. So we're a pure play upstream oil and gas company. We explore, we drill, we develop, we operate, and we sell. We don't do renewables, we don't do broad energy strategies, nothing of that. If we were to choose, we would do FOB sale and not be involved in that part too, right? So really, that's the first part of this. Concentration is a part of the success, because every time you think you can do something else, you're forgetting the learning curve. And you're forgetting that people have been climbing that learning curve long before even you and I were born, right? So that's why we're Norway focused, pure play. So it's a concentration game. There are 3,000 people in Aker BP. They need to get up every morning knowing exactly what they're going to spend their time on. And then the second is, yes, there is a certain physical limitation. But I've been surprised of how much of that physical limitation is self-imposed. A couple of examples. We have now been drilling wells with, I don't know, for many years, and we basically populated the benchmark P25 plus. So you can't come to me with a well budget and it's not P25. But then we implemented wired pipe, which is basically putting a fiber optic cable into the wells, and we took out all the old empirical models, and we discovered that there was an enormous amount of truth that was simply not truth. So we were drilling an exploration well, 43,000 meters of reservoir coverage, 43 kilometers of reservoir coverage in 3 months, 7 branches. And we were drilling the reservoir with directional control and staying within a certain, we basically looking for the oil, right? So staying within a certain vertical difference, 60 centimeters or so. And we were drilling them at 150 meters an hour. If you were to try to do that, the conventional technology will tell you that that could not be done. Cuttings loading, which is another limiting factor. People will say 5, 6, 7% of solid is probably where you have to stop. We've demonstrated 17%. So I'm surprised of how much of this kind of physical limitation is self-imposed. So I think that is number one. I don't know where that is, but there are obvious restrictions, but I don't think they are where we think they may be. I think there are significant improvements to be done also there. But then if you look at the timeline, what is not taking time, what is taking time in a field development, it's not necessarily the blue collar part of things where you're welding and drilling and doing all this stuff. It is the engineering part of things. And the thing is that if I can actually get that compressed by a factor of 2 or 3, then I don't need much of physical improvements to get time to market down by a factor of 3. And this is a fairly interesting observation, right? But if you're going to spend a year doing procurement, well, obviously not going to make it. If you're going to spend 6 months or so deciding on the concept, well, that's probably a waste of time. We've got agents that help us do concept selection, probably take us a week. If you stay within the confinements. If you can start doing vibe engineering, then everybody can do engineering, so you're no longer constrained by a certain set of professionals, etc., etc. So my strategy is very simply put, let's use the fact that we're focused, the fact that we do only one thing, and there's a certain set of possibilities, see if we can actually really compress that timeline. If that turns out to become, call it a competitive advantage, Obviously, that could be something that somebody else could take to another market, but it's probably not going to be Aker BP because we are focused on what we're trying to do. But there is a certain set, of course, of capabilities that could be deployed in another setting.
You can take things down by a factor of 3. It clearly is going to open up oil to recover that would not otherwise be the case. I want to morph the question slightly. I know it's near and dear to Maynard's heart, and I think you'll appreciate it, is how do you see the environment within Norway from a European context? And we think about Europe, and I apologize for being an American in this description.
No, you shouldn't.
As being sort of prioritizing climate and climate type issues, and therefore not fully embracing what I think is a phenomenal resource in terms of the domestic oil and gas within Europe broadly, but specifically Norway. And I think Norway has stood favorably apart from some of the other countries within Europe, clearly, but I'm still not fully sure the degree to which the Norwegian people, the Norwegian government, you tell me what the right level of focus should be, how much they're going to embrace your willingness to continue to push the envelope to potentially raise oil and gas production out of Norway, perhaps to go into areas that an environmentalist might deem environmentally sensitive in the northern parts of your country offshore. Just a little bit of background on the politics within Norway and how that's changed post-Russia, Ukraine, now the Strait of Hormuz crisis, and the reality of the world we actually live in.
Yeah, it's a really, really good question. Probably split it in 3. So let's start with kind of the policy and the policymakers and the public opinion in Norway. To a large extent, that's always been supportive of the oil and gas industry. Yeah, there might be discussions, but if you're 30 to 40% of the nation's GDP, any politician with any sense is coming to the conclusion that this is too important to stop doing. And I think this, because of that kind of volume of the oil and gas industry in the Norwegian economy and in the Norwegian society, that the public support has always been quite clear. The European market has fundamentally changed. So that's gone from, call it, a transition-focused strategy to a security of supply-focused strategy, for obvious reasons. Crimea first, and then Ukraine, and now you talked about Hormuz. So this string of high consequence with low probability events ending up in a situation where lots of the European policymakers are now contemplating the idea of a shooting war in Europe is changing how we think about security of supply. That is a very fundamental change. It started out obviously with gas to Europe, but now after Hormuz, I'm having increasing conversations where petroleum products and oil is equally important, because your mindset is changing. And I think it is a fact that the industry has been unable to convert these, call it, energy transition strategies into economic results. You talked about Equinor and their earnings calls and the public debate around capital allocation. But in reality, it is difficult for an oil and gas company for 3 reasons. The first one is you are going to concentrate on something. The renewable business model is very different from the oil and gas business model. It's not the same. I mean, I use this analog saying, okay, you want to play handball, which is big in Europe, and you want to play soccer. That's two goals, 1 round ball, 2 teams. And yeah, you might find a McKinsey consultant say if you can play soccer, you can play handball. But there's never a team who won the World Cup in soccer and won the World Cup in handball at the same. That's never happened, right? So this assumption that a lot of the underlying capabilities automatically makes you excellent is probably erroneous. And the second topic is you're ending up in a situation where the underlying return on capital employed in the renewables market are significantly lower because you're actually selling a product to a consumer that has a limited willingness to pay. Whereas in the oil and gas business, you're selling a product on a global market where it's basically the state of the market that sets the price. So two very, very different business models. And then I think the third one is we have had an energy addition, not an energy transition globally. So while electricity and electricity production has increased significantly, it's come on top of a, call it a 1.5 to 2% increase in hydrocarbon supply and demand, not transitioning away from that supply and demand. So that means that the planet itself is consuming more energy. And now, in the last year or two, of course, also driven by the fact that artificial intelligence seems to consume much more energy than we had planned for originally. And that kind of leads me to the conclusion. I think it's a given, also from a European perspective, that Norway needs to continue supplying the European markets with oil and gas. And we're supplying roughly the same kind of equivalent of terawatt hours in gas and oil products. If anything, I would argue that it is more strategically important now than it used to be. And it's changed from being purely a gas play to being a hydrocarbon play, because everything is now turning into security of the supply type of strategies, right? Minerals, trade patterns, trading routes. Who thought that Hormuz would be closed for 15 weeks? If you ask the policymaker or a risk analyst 20 weeks ago, what would they say? 2, 1, 2, 0.5%, right? And now it's been, and the capital markets are not really pricing in that. That's my last, right there. To me, we're starting to see the capital markets pricing in security of supply, physical supply, in a way they haven't done before. It's always been assumed, and now it's starting to become priced. That's also kind of driving up the same kind of set of stairs that the policymakers are now facing.
Guys, I'll confess, I can't remember a COBT. We've had them, we've been lucky, but just kind of been like on the edge of my seat the whole time here. Maybe one place to wrap up. I was thinking about our history with you. We met you in 2016, 17, when, digitalization was the new thing. And that's about as far as it went. And then obviously the world went through a period thinking about energy policy in a completely different way. It's changed. And then I was thinking, and I remember sitting with you, I think it was 2024.
Yeah.
And you asked me about AI. And, you were well down the road, and I was just sitting there saying, I have no idea. And now here we are. So when you think about this 16, 17, 24, 26, and then look out on the horizon, if I couple it with your comments on exploration, I was sitting here thinking it has to be the case oil will be easier to find broadly, and we'll have more of it, and it won't cost as much, and we'll live in a world of plenty. But then I started thinking, you're operating in a unique environment with unique data, unique people, unique capabilities that it doesn't necessarily transfer to the rest of the world. And there's going to be so much spending, from people and data and on-premises, hardware, et cetera. So I'm just trying to ask you, we wrap up, when you think about what the world looks like, 5, 10 years out at this pace of change, what do you think it means for oil and gas, for some of these topics we've talked about today?
Yeah, again, a really good question. A few bullet points, maybe. So first, I think artificial intelligence and the way we're thinking about it is going to create winners and losers at the pace we haven't seen before.
Mm-hmm.
Because we've always been in this kind of incremental industry where technology has basically been about expanding the capability envelope. And it's basically been distributed. So you have almost like a competition model. And the big service companies have essentially spread that knowledge quite effectively across the ecosystem.
Mm-hmm.
Now you can actually start to see at least a possible scenario where that is not necessarily the case, because the skill sets of these companies will develop a very different trajectories. It's not like they're not deploying the same technology, but it's just that technology is so capable that those that are deploying it efficiently can get much more out of it than those that are deploying it inefficiently.
Mm-hmm.
So that's probably one. Second, it is not necessarily just about the structure. It's equally about the business model and the culture, which is why I think your assessment that everybody will be doing this is essentially wrong. I think it's actually very difficult to copy. And that means that I do believe that a certain set of companies will be outperforming other companies. And this is why that belief is why I'm so determined to push Aker BP in that direction. Mm. And then I think we need to be prepared for extreme volatility. And your point, I actually really subscribe to that. I think we need to think about resilience, not risk management strategies, because we can't really predict what's going to happen. We need to start thinking about how we create structures that are resilient to a high frequency of low probability but extremely high impact events. Mm. And again, easier to do if you're a smaller company than if you're a significantly bigger company. Which is also, I think you're ending up in this idea that maybe the future is, in the future there will be a set of specialist companies filling different roles in this oil and gas ecosystem, but collaborating in a different manner to make sure that the efficiency in that ecosystem is significantly higher than what we have today. Because in reality, if you have this large vertically integrated companies, you may end up in a situation where the efficiency is not high enough. So you're actually getting to somewhere where it almost feels like a bit of a synthetic business model. It's part tech, right? And it's kind of winner takes it all type of approach. And it's part physical, driven by the physical limitations, because we are a physical business delivering a physical product. So it's a fairly interesting. It's a fairly interesting strategy.
Well, we're ending on a very so many interesting comments there, but this reintegration, Arjun, this was super spiked in the last couple of weeks about industry structures and how they may change and how people may get back into businesses they used to be in. But the notion of synthetic integration, for all the reasons you pointed to, and the alliance model, that's very interesting. Well, tremendous. Kali, holy smokes. Everybody had their Wheaties this morning, is what we'd say in the U.S. But thank you so much. We're so glad you're in Houston, and we're so glad that you're a friend. We learned a lot today. Thank you, everybody.